Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Asian stocks join a global rally after cooling labor data and inline U.S. inflation cements expectations for a Fed cut next week. Discussions with Doha. Axios reports U.S. President Donald Trump is expected to meet with Qatar's Prime Minister this evening in New York, following Israel's strike against Hamas leaders. Plus, OpenAI and Nvidia plan to pledge support for billions of dollars in UK data center investments as US executives join President Trump on his state visit next week. It's just gone 8 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. Well, it's been a solid week for U.S. equity markets and the same thing as well for global markets. And in a while, we're going to speak about the AI rally that we've seen this week in some of those Asian stocks. But yesterday, the big event was CPI data coming pretty much in line with expectations. So I will say jobless claims got a lot of attention yesterday because those figures reached the highest since 2021. So a cooling labor market continues to be one of the themes that's emerging in the U.S. But mostly, for the most part, Wall Street brushes off some of those macro downside concerns aside. Another record high for the S&P. This morning, we've got 10-year yields basically sitting at 4.03. But after those jobless claims figures came through, we broke through 4% to the downside. We sort of sold off a little bit afterwards. The point is, we have come a long way. It was only 2 weeks ago we were talking about a massive sell-off and steepening in the U.S. yield curve. We flattened all the way back again. So something to bear in mind vis-a-vis positioning. Euro also in focus, 117.30 after, I've got to say, it's a not really exciting ECB meeting yesterday. The ECB President Christine Lagarde seems to be quite happy with where things are and where inflation is, hinting that they're pretty much done with the rate cutting cycle. So you've seen a bit of a lift to the euro. Gold also in focus, 3,650. I believe that is yet another all-time record high. That seems to be the case every day as we walk in. Money continues to pour into gold, and analysts keep revising upwards their targets of where we're going to get to. Last but not least, S&P futures trading sideways, but of course at an all-time high, as I mentioned at the top. I want to switch over because we had some interesting IEA data coming through yesterday on the oil front. Take a look at this. This is their forecast for the surplus, the oil surplus for 2026. So remember, we've been speaking about bearish fundamentals in oil as we head into the fourth quarter, as we head into 2026. Pretty bearish outlook put through from the IEA yesterday, suggesting that there will be a mismatch of 3.3 million barrels a day in 2026. That is a substantial number, and one of the reasons that analysts on the street continue to be quite bearish about where oil can go from here. Okay, let's also check in on how markets in Asia are faring. David Inglis joins us from Hong Kong. I guess it's AI.
It really is. And in many, actually, iterations of the AI story. So what's happening in China, which I'll get to in a moment, and what's happening elsewhere in the Asia Pacific are actually almost separate strands of the AI story. In China's case specifically, we're on the lunch break here, is that Alibaba's introduced this new AI model that's looked to be more efficient. That's point number one. When you look at what's happening across the region, so this is like when you look at the TSMCs, SK Hynix, which was really the big driver going into the open today, was really there as far as their own AI milestone was concerned, as far as NAND and this NAND conversation goes. So we're going to show that very, very shortly on your screens. Now, all things considered, you look at what's happening as far as the Chinese tech space is concerned, Asian chips, is we are now pushing very close to a record high on the Asia Pacific benchmark when you look at MSCI Asia Pacific. As promised, SK Hynix 7% over in Seoul. Very quickly, we're at session highs right now on the Asia Pacific benchmark. We're extremely close to that record high. That's where we are currently. Remember that number, 220.53, 220.61 is the number you're tracking. In fact, on the Bloomberg chart, I'll end on this and I'll send it back to you. We're within a hair, maybe my hair because mine's thinning, to that record high that we hit back in 2021. Back to you.
All right, 220.53. It is imprinted over here. I'm going to have to keep watching that throughout the course of the show, just in case it happens. David Inglis in Hong Kong, thank you so much. All right, to pick up the conversation, joining us now is Karine Kheirallah, Head of Investment Strategy and Research for the Middle East and Africa at State Street Investment Management. Good morning to you, Karine. Thanks so much for joining our show. Let's start with your expectations for the Fed next week. Yesterday's CPI data, I was just flagging it at the top, came in line with expectations. Perhaps not enough in there to suggest that the Fed should actually opt for a 50 basis point rate cut next week. What's your view?
Good morning, Joanna. Yes, I mean, CPI data came in, as expected. There was no surprise there. It was in line with estimates. But we started seeing, some pass-through of tariffs in some goods and some services. But we also saw some softness in some other services as well, like, medical care, recreational costs, and rental car rental as well. But overall, I mean, the inflation is still above the Fed target rate of 2%. We still have the opinion that the Fed will cut to 25 basis points next week. But what was more concerning was actually the jobless claims that came in yesterday. They came in much higher than expected. And it was just, confirming that the weakening of the labor market is very much there.
Yeah.
And I think this is where the Fed will focus more. I think the all eyes is really on the job side of the equation, I would say. So this is really confirming a 25 basis point rate cut for next week.
Yeah, so let me pick up on the job side of things, because those jobless claims figures, I also flagged that in the introduction, the highest level since 2021. At what point does the weakening of the U.S. labor market actually become bad news for risk-on indicators? At what point does bad news actually become bad news? Because so far, stocks continue to rally. The Fed easing cycle has actually been a tailwind, you could say, for stock markets. But when does bad news become bad news?
I think that the bad news becomes because so far we've seen slow hiring, but we haven't seen outright firing. And I think the moment, the catalyst would be really when we start seeing companies fire dramatically. And this is where we would see bad news. And this is when we will see actually the major impact on the market as well. So far, the economy or the market have been quite resilient, even though consumer spending has been slowing down. And in order to actually keep the consumer spending growing, it is crucial, for the labor market, like I said, to avoid that firing. And I think to recalibrate the interest rate lower is very important in order to prevent that shift.
Yeah. Are you surprised by how much U.S. 10-year yields have rallied back over the last 2 weeks? It was literally only a couple of weeks ago we were talking about extra term premium, the steepening of the U.S. yield curve. And yesterday we broke through 4% to the downside.
Yes, I was surprised as well. It's as if, the treasuries are back on track in terms of, given the uncertainty in the market and the I would say, because, I mean, we still don't have the full clarity on the tariffs. And I think it's where the investors were, again, treating the treasuries a bit as a safe haven. And so we saw, the treasuries rally. But however, we saw them, going back up again towards the end of the session. But yes, I mean, it's still yet to be seen. I mean, I think it's just a temporary thing. I think, with gold prices going higher, it's putting, again, downward pressure on the treasury yield curve as well.
Yeah. In terms of where you want to be allocated right now, in light of everything we discussed, the macro backdrop, the imminent rate cut coming from the Fed, at least we anticipate there to be an imminent rate cut, where do you allocate your money in the most optimized fashion that's also playing on the fact that there could be potential downside to the economy coming in the coming months as well?
Yes, I mean, indeed. I mean, the economy is slowing down, and we've seen, weakening, but we don't anticipate a full-on recession. We think it's just, a short-term, kind of a softening of the economy. We expect the economy to reaccelerate going into 2026, supported, by fiscal stimulus and monetary easing. So in light of that, we're still constructive on U.S. equities. I mean, they've performed pretty well so far. They continue to lead on profitability and earnings strengths. Their performance is really supported by strong fundamentals. We still think that, there's a run-up for the U.S. equity market from where we are. And we also like gold. Gold has been part of our portfolios for a long time now.
Yeah.
It's been picking up quite well.
It's a winner.
Yeah, it is a winner. It's, I think, up 40% since the beginning of the year. We continue to like gold. It's well supported. I mean, it's a hedge against inflation, against geopolitical tensions, and all the volatility that we've seen in the market. And central banks are continuing to buy gold. They've been a buyer of gold for the past 15 years, and that has given it a good support, for the gold.
Karine, really great to have you on today. Thank you so much for joining us. Karine Kheirallah, Head of Investment Strategy and Research for the Middle East and Africa at State Street Investment Management. And coming up, we discuss the aftermath of Israel's strike on Hamas leadership in Doha with Hasan Alhasan from the International Institute for Strategic Studies. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. President Trump is reportedly expected to meet with the Qatari Prime Minister in New York this evening to discuss the aftermath of Israel's strike on Doha. Sheikh Mohammed bin Abdulrahman Al Thani is also set to meet with U.S. Secretary of State Marco Rubio earlier in the day. That's as international condemnation of the strike grows, with leaders and representatives denouncing the move at a UN Security Council emergency meeting held on Thursday. Now, France once again reaffirmed its support for a two-state solution at the event. However, Israel remains defiant, with Prime Minister Benjamin Netanyahu vowing there will be no Palestinian statehood. He was speaking at the opening of a new settlement in the West Bank yesterday. To discuss all of these developments, and there's certainly a lot this week, joining us is Hasan Alhasan, Senior Fellow for Middle East Policy at the IISS. Well, this has been one of those weeks that really could change the course of the region over the next decade. Let me just start off by asking you whether you think this constitutes, and the attack on Doha constitutes, a reframing of how Qatar views its relationship with the United States, knowing that later this afternoon the Prime Minister will be meeting with President Trump.
Yes, I think it's prompting a rethinking of relations with the United States, not only in Qatar, but I think across the wider region, perhaps throughout the rest of the Arab Gulf states as well. Because although there's been already a deeply entrenched sense of U.S. unreliability as a defense and security partner, I think the Israeli attack on Doha really takes it to a whole new level. In the past, frustration in the Gulf with the U.S. has primarily been about the U.S.'s failure to bring about a robust response to threats emanating from U.S. and Gulf adversaries, including Iran, the Houthis, and so on. This time around, this is an ally of the United States that benefits from U.S. funding, from U.S. military support, from U.S. political and diplomatic cover, which was the perpetrator of this attack on Qatar. So I think, unless we see robust measures on the part of the United States, unless there is punitive action against Israel or Netanyahu, or really a genuine effort in Washington to hold Netanyahu to account, which I don't think will be forthcoming, then I think this perception of U.S. unreliability will be further entrenched. So I do see this, I think, as a turning point in the way the U.S. is seen, not just in Qatar, but throughout the entire region.
Yeah, yesterday my colleague Sam Dahed wrote a piece about how Gulf states are rethinking their security guarantee relationship with the United States. But I just want to ask you, from your perspective, how can they reevaluate the security guarantees? What is the reshaping of that relationship look like? Because, at the end of the day, there is still the U.S.'s biggest base in the Middle East, in Doha. It's not easy to unwind that relationship.
You're absolutely right. It's extremely difficult, in fact. I think there was a high sense of optimism, and I think over optimism, in fact, vis-a-vis what the Trump administration could offer. I think this was a pervasive attitude in the run-up to the Trump administration, or President Trump assuming office, and up until his tour of the Gulf, where hundreds of billions of dollars in deals were promised, and essentially this was seen as a high in U.S. relations with the Arab Gulf states. I think that sense of optimism has now faded. I think we are in a different phase of the Gulf states' relations with the United States. But practically speaking, how does this sort of materialize when the defense and security relationship is concerned? It's extremely difficult, because The U.S.'s defense and security partnerships with the Arab Gulf states are deeply entrenched. They've been around for decades. They're foundational to the way that the Arab Gulf states sort of think about and carry out their defense and national security strategies. The problem is that this partnership is no longer adequate for meeting the new threat environment that the Arab Gulf states have to deal with. It's fantastic for deterring Iran and for defending against Iran, but it's really ill-equipped for defending against or deterring threats from Israel. So the Gulf states don't have any good options in the short run, but in the medium to longer term, I would expect further diversification of defense relations, a renewed effort to accelerate defense industrial production indigenously, and potentially a closer banding together of regional allies and partners within the GCC, but also other like-minded.
So let me pick you up,
in the region.
Yeah, let me pick you up on that last point of closer relationships amongst these Arab Gulf states, amongst each other. I think a summit is going to be held this weekend. Qatar holding an extraordinary summit with other Arab states. And one interesting development over the last couple of weeks is the UAE. The statements that is coming out of the UAE have been a lot more in the realm of condemning Israel. And of course, this one is one to watch because UAE are signatories to the Abraham Accords. I've been reading in certain parts, some parts of the analyst sphere think that if UAE want to go one step further, they could actually consider withdrawing from the Abraham Accords. Do you think that that's a real possibility at this point?
So I do think that countries in the region are converging on the perception and on the view that it's not only Iran that constitutes a threat to national security and regional security in the Gulf, it's also increasingly Israel. And so you have this sort of dual threat environment coming from both Iran and from Israel as well. Now, I think the Gulf states have a menu of options available to them in response and in retaliation to Israel's brazen military aggression and attack on Doha. They could choose to exercise a host of diplomatic and political options, including putting the Abraham Accords on the table. So the UAE and Bahrain are signatories of the Accords, and the UAE has already drawn a red line around the annexation of the West Bank. But I would say that an attack on Qatar, which has a collective security essentially clause with the rest of the Gulf states, is highly significant and worthy of consideration as well. So that's an option. The Abraham Accords, I think, are a point of leverage that the Emiratis and the Bahrainis could exercise. But I think the rest of the Gulf states could also, in a coordinated and robust manner, lend further support to cases against Israel at the International Criminal Court, at the International Court of Justice. They could also enforce wider boycotts of Israel's economic interests and of third-party companies that are seen as being sort of closely supportive of Israel. There really, I think, is a wide toolkit of economic and diplomatic pressure that the Gulf states could choose to exercise should they decide to enact measures in a robust and coordinated manner.
Yeah. Hasan Alhasan, Senior Fellow for Middle East Policy at the IISS. Always good to talk to you. Thank you so much for coming on our show. Now, coming up, OpenAI and Nvidia are said to be heading to the UK with billions in tech investment, timed with President Trump's visit. The details next. This is Bloomberg. Shares of FirstRand, Africa's largest financial services group, soared in Thursday's session after reporting record annual profit. That's even after increasing provisions to cover costs linked to a long-running probe into missold car loans in the UK. Group CEO Mary Vilakazi spoke to Jennifer Zabazaja about her outlook for 2026.
The structural economic reform agenda that's in South Africa, although the results are not quite visible as yet, but we are constructive that we're making progress, and there will be a time when the energy and the transport sectors are not constraints anymore on the economy, and all of that is benefiting small businesses. So we're largely constructive when I look at the SA side. I mean, I think the only potential headwind is what happens globally. And we've seen that, I think the global uncertainty on tariffs, on economic policy, that has already impacted growth expectations of South Africa. I think we've pulled back. If I look at the Bloomberg survey, expectations of growth beginning of the year were 1.6 GDP, and now that's pulled back to 1%. So, yeah, so no doubt we watch what's happening around the world.
And Bloomberg has learned that OpenAI and Nvidia are planning to pledge support for billions of dollars in UK data center investments. That's when CEOs Sam Altman and Jensen Huang are set to visit the country next week. Our Asia Tech correspondent Annabelle Jewellers joins us for more. What do we know about this potential investment into the UK next week?
Yeah, well, this is quite a significant one. So essentially, there's going to be a delegation of US executives traveling with President Trump to London next week. And we are hearing from sources that Nvidia and OpenAI will announce a multi-billion-dollar investment into data centers in the UK. So this would be in partnership with Nscale Global Holdings. That's a UK-based or London-based data center business. Essentially, I mean, this is sort of speaks to what Keir Starmer has been looking for, the UK Prime Minister. He does want to have plans to turbocharge AI, to have more investment into data centers, to chips. It also aligns with OpenAI's goals because they want more investment into the EU or across the continent into the UK as well. But again, this is sources familiar with. Wait, of course, for confirmation on that possibly next week.
And another news story overnight, OpenAI and Microsoft potentially having reached an agreement about the structure of their partnership. What do we know there?
Yeah, this is also interesting because we know that there's been an ongoing leadership or some issues among the leadership at OpenAI around the structure of the business because it has that non-for-profit umbrella structure at the top. Now we're hearing that they've signed or they've announced that they've signed an MOU with Microsoft over the shape that this is going to take moving forward. So the plan is to create a new public benefit corporation, and then OpenAI will take a stake in that. So public benefit corporation, it can make money, but it also needs to have ESG goals to operate alongside that. What we understand from that is that this stake or this investment of $100 billion, that would be worth around 20% of OpenAI today. It is the floor. It could increase from here, but it does just come after there's been really talks going on for months and months between OpenAI and Microsoft, and that question again of the for-profit, non-for-profit structure has sort of been perennial for the business as well. But you did actually see a bit of a reaction in Microsoft and after hours rising. So clearly investors as well did like this announcement from the companies.
Seems to be the case. Asia Tech correspondent Annabelle Jewellers, thank you so much. And coming up, Turkey's central bank delivers a sizable cut, slicing its key rate by 250 basis points. All the details next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks join a global rally after cooling labor data and inline U.S. inflation cemented expectations for a Fed cut next week. Discussions with Doha. Axios reports U.S. President Donald Trump is expected to meet with Qatar's Prime Minister this evening in New York after Israel's strike against Hamas leaders. And a faster pace. Turkey cuts interest rates by 250 basis points, defying Wall Street expectations of a more significant slowdown. It's just gone 8:30 a.m. across the Emirates. I'm Jemana Bersachi in Dubai. Well, AI has been a major theme, not just for U.S. markets this week, but Asian markets, as David Inglis is going to walk us through in just a few moments. But the main events yesterday, inflation data coming in line, cementing expectations for that 25 basis point rate cut next week. 10-year yields briefly dipped through 4% yesterday after a weak jobless claims figure, the highest number since 2021. So some weakness still in the labor market. Europe moving a little bit higher after no fireworks ECB. The ECB President Christine Lagarde signaling that they're essentially done with rate cuts at this point. Gold very close to all-time high, up another 0.6%, and S&P futures trending sideways as we get into the European session. Switching over, I just want to flag as well, a report came through from the IEA yesterday. Always interesting to see their notes on the outlook for the energy complex. They are forecasting a massive oil surplus in 2026 to the tune of 3.3 million barrels per day. So if that does happen, you could expect to see some more downside pressures on oil emerging, as many in the streets are anticipating going into Q4 and 2026. Okay, let's check in on how markets in Asia are faring. David Inglis joins us from Hong Kong. David.
Yeah, Jumana, so as you were just pointing out, right, so here's a bit of a tidbit for you. The Chinese word for AI is actually AI, and romanized there, of course. I think those two concepts have intersected and, in fact, coalesced in a headline and in a market theme today. Hang Seng Tech Index 2.2% to the upside. A lot of the tech-heavy benchmarks, as you can see, are leading this rally. The Nikkei is continuing to extend a record, as with the Kospi Index. Large caps as a theme have also done very, very well. Individual names, I won't go through each and every one. We've been talking about Alibaba, this new AI model that they've introduced, more efficient one. That's leading to these gains across the Chinese cohort of the AI space. And of course, on chips, you have SK Hynix, of course, also leading that on the back of their own AI milestone on HBM4. Now, all this being said, you had the AI story. You have, of course, the Fed conversation. You have a depressed dollar, which is trading at about 10-week lows, thereabouts here. And we have the Asia-Pacific benchmark, which is extremely close to the high that we hit back in 2021. So that's about 10 pips from the current level. Effectively, the chart shows you here, Jomana, once this disappears, we'll be at a record high for the Asia-Pacific. Back to you.
Yeah, we are on close watch. David Ingles in Hong Kong, thank you. Now, Turkey's central bank has delivered a sizable interest rate cut. The central bank cut its key rates more aggressively than forecast, dropping the repo rate to 40.5%. 40.5%, wow, still high number. The move comes as policymakers signal confidence in tackling disinflation. Now, bets on a Fed rate cut next week, so that's the U.S. Fed, are also boosting EM assets. So let's get the market outlook with Luis Costa, head of emerging market strategy at Citi. A lot to talk about. Maybe I'm actually going to start with the micro, which is the surprise cut by Turkey yesterday, 250 basis points, more than the market had been penciling in. The reason I bring it up is the Turkish carry trade has been such a popular trade in the last 12 months, obviously barring a few political surprises most recently. Given the fact that the central bank has cut so aggressively, does that jeopardize the potential carry trade that investors are viewing?
Not necessarily as yet, Jomana. I think that you mentioned the real yield valuation. When you mentioned the policy rates, oh, wow, I mean, we're still like at 40, right? Given the prospects of disinflation, the central bank has some room for further cuts. So as a matter of fact, if you look into the derivatives, the cross-currency swaps, I mean, there was already some expectations of sizable cuts yesterday. It was not necessarily totally unexpected. So in terms of real rate valuation, what is what? I mean, nominal rates discounted by the inflation expectations. Where do you believe inflation will be over the next 6 to 12 months? There is a space for Turkey to cut rates and still under an okay performance of the currency. We are still, short dollar Turkey. Yeah. We still believe that there are prospects for good performance of the spot versus the forwards.
Okay, interesting. Let's take it back to the broader and what I've been talking about throughout the rest of the show, which is the anticipation of the second wave of the Fed easing cycle commencing next week. What implications is that going to have on EM assets? Because so far it has actually been an absolutely stellar year for EM in terms of inflows, in terms of performance, in terms of credit tightening. How does the narrative change once the Fed actually does start cutting interest rates?
Historically, there's a pretty good tendency for international risk, and that incorporates EM as well, to trade well as we go into the beginning of the resumption of easing. We know that there was a long pause, and now the Fed is about or supposed to continue the easing cycle we started many quarters ago. So there's a space for international risk to trade well. EM, as I said, especially on the currency side, it still has a very interesting nominal and real rate valuation. And also, let's not forget the technical aspect of it. Flows. Markets 6-9 months ago, markets were not necessarily prepared for this excellent performance on the EM currency side. So we continue to see prospects for good inflows into EM funds, and that will probably take us into 2026.
What's your view on the fixed income side of things? Obviously, hard currency, has performed quite well, but on local bonds in an environment where, even in the U.S., people have concerns about positioning in the long end part of the curve. Does that also translate to EM fixed income as well?
Absolutely, it does translate. If I go and if we try to poll 100 EM clients here, maybe 5 or 10 will have structural positions in duration. Duration is still a little bit of a curse word for fixed income investors. There's still a lot of caution when it comes basically to the back end because of the price action in the back end of core. So what you see that the average investor engaged in belly of the curve positions, front end of the curve positions, both credit and local. The major challenge here will be beginning of the next year. At a certain point in 2026, I think that there's a risk the U.S. economy reflates too fast. Let's not forget, this is something that we wrote in our report yesterday, right? The U.S. economy is already coming from a loose financial conditions position. It's not tight. So as we get a little bit more loosening on the monetary policy side, equities trading well, high yield spreads, at the tights, I think that will probably set up the stage for a faster than expected reflation in the U.S. economy. And then I think that the equation can change quite a lot for international risk, including EM.
Okay, that's a really interesting report to flag also the potential upside to inflation in the U.S. in 2026. It's something that we've got to keep on our radar. I want to bring it back to another phenomenon we've been discussing with my colleagues in Asia, and that's the fact that Chinese stock markets and Asia Pacific indices have really been on a tear recently, and a lot of that can be attributed around some of the hype around artificial intelligence, the chip makers. To what extent do you think this market phenomenon in China is going to lift all boats in emerging markets?
It is very supportive of Asia equities, that's for sure. I mean, let's not forget that in the grand scheme of things, markets were already invested in some parts of Asia equities, but the Asia tech had a renaissance after the DeepSeek events. We remember many months ago, that was a big wake-up call for EM equity investors, and now there's a lot of more scrutiny, a lot more positivity in what these single names can do compared to the U.S. benchmarks we already know of. So I do believe that will probably continue. If you use the EV sector as an example, there was a lot of catch-up in the Asian names compared to whatever the Western names were doing. I don't think this is going to be very different when it comes to AI. So you got to keep an eye on that, and we do believe that the positivity will probably stay.
Yeah, so interesting. Luis Costa, Head of Emerging Markets Strategy at Citi, thank you so much for coming on the show. Well, as we were just speaking about with Luis, Turkey's central bank delivered a sizable interest rate cut of 250 basis points. The move comes as policymakers signal confidence in tackling disinflation. For more, we are joined now by Selva Bahar-Raziki from Bloomberg Economics. So they surprised with this 250 basis point rate cut. Is that a sign that the pace of easing ahead for Turkey is about to ramp up in magnitude?
Good morning, Jumana. Yeah, the central bank definitely surprised to the upside, moving in a larger step than we had the 200 basis points we had penciled in for this meeting. The statement makes it very clear that the board is extremely optimistic about the disinflationary outlook. The central bank thinks that the steps it's taken is in line with the 24% year-end inflation that they have set as a target for this year. We agree with the direction. We think that inflationary pressures are easing. Growth is definitely moving into a more slower profile, also helping ease pressures. However, we disagree with the pace. We think that year-end inflation is headed towards 28%. The market is at an even higher 30% at the moment. So that suggests that the central bank has easing space ahead. However, it's going to have to move in more measured and moderate steps going forward. We see 35% as a year-end rate within reach, but that's of course subject to inflation risks, as well as the current ongoing potential hit on investor sentiment regarding the lira.
Yeah. Selva Bahar-Raziki from Bloomberg Economics, thank you for giving us an overview of what we got out of the Turkish Central Bank yesterday. Now for a look at some of the other stories we're following. Citi CEO Jane Fraser says M&A activity is rebounding as U.S. companies gain confidence from clearer policy signals. Speaking to me exclusively yesterday, she added that she does not see a recession in the world's largest economy on the horizon. And pivoting to the Middle East, Fraser's stock struck a more optimistic tone, forecasting a decade of strong growth fueled by investment flows and the creation of new industries.
We have been growing very rapidly in wealth management in some of the major offshore centres, and I am particularly excited about the opportunities here because we're seeing the Middle East, Abu Dhabi, Dubai in particular, as well as Saudi, getting a lot of attention from India, from China, from some of the wealth that's being created in Africa, as well as the traditional areas, and indeed here in the Middle East, because there's a vibrant private sector and a lot of wealth creation.
U.S. Treasury Secretary Scott Bessent will meet with Chinese Vice Premier He Lifeng in Madrid next week to discuss trade, economic, and national security issues. The discussions will cover TikTok's status and efforts to combat money laundering, according to a schedule released by the Treasury Department. A 90-day tariff truce between the U.S. and China is set to expire in early November, which looms as a potential flashpoint for renewed economic tensions. President Trump has asked the federal appeals court to pause a lower court decision blocking his ouster of Fed Governor Lisa Cook. The request for a stay order would likely allow the firing to take effect before the appeal is formally heard. The administration wants a ruling by Monday, the day before the Fed board starts meeting to vote whether to lower interest rates. If the request is denied, Trump is likely to go to the Supreme Court. So ongoing legal developments there with the Lisa Cook situation. Coming up, Israel's defense industry faces pushback. The UAE bars Israeli firms from one of the world's biggest air shows as regional anger over a strike on Doha and a Gaza offensive deepens. More details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Europe's outrage over Israel's campaign in Gaza is fueling calls for sanctions and even a rethink of political ties. But one sector remains untouched: Israel's booming defense industry. European countries bought $8 billion worth of Israeli weapons and defense systems last year, and demand is expected to rise as NATO members ramp up spending. For more, we're now joined by Bloomberg's Paul Wallace. Paul, given the protests and political pressures across Europe, how sustainable is this defense relationship going ahead?
Hi, Jumana. It's a big, big question, and Israeli defense firms are certainly worried about Israel's sort of, if you like, the growing anger about the country across much of the world, especially Europe. For now, the numbers for Israeli defense firms look pretty good. As you mentioned, that $8 billion figure, which was just over half of Israeli defense exports last year. Overall defense exports from Israel are going up very rapidly. There's a good chance that this year is even better for them. Israeli defense tech is known as being very, very good, very, very sophisticated, and crucially, it's battle tested, obviously because of the war in Gaza. So for things like air defenses, Israel is pretty much thought to be about to have the best air defenses in the world, but also technology like drones. So you've got countries like Germany, which have signed billions of dollars worth of contracts recently for drones and air defenses. But you're right, that issue of how sustainable it is a problem, and our reporting has told us that Israeli defense officials are being told by potential customers in Europe and elsewhere, if you get the war in Gaza over, that's going to make it much easier for us to buy from you. And while our talks are going on about weapons purchases, please keep them quiet. We don't want these public.
Yeah, I mean, speaking about the backlash also in the Middle East, Israeli defense firms now barred from the Dubai Air Show. How significant is this setback for Israel's defense industry?
I think it is is a setback both for the defense industry and for Israel as a country. The air show is the biggest aerospace air show in the world. It's held in November, so to be barred from that is a big problem. And then these events are also a very good opportunity for companies that attend them and have booths and things like that to show off their weaponry and their defense equipment and to win more sales. So it is a big blow. There is a chance, it's still to be seen. I mean, we've seen sort of France and UK take sort of similar moves against Israeli defense firms with air shows recently. In some cases, Israeli firms were allowed to show purely defensive equipment, but it does seem like they will be barred completely from this Dubai one, which is definitely a blow to them.
Bloomberg's Paul Wallace, thank you so much for the latest there. Now, former Brazilian President Jair Bolsonaro has been sentenced to 27 years and 3 months in prison. That's for plotting a coup after his 2022 election defeat. This makes Bolsonaro the first former president convicted of such a crime in the country. His lawyers are expected to appeal his sentence. The U.S. has warned it will react accordingly to what they call a witch hunt. And coming up, we hear from the CEO of Vitality parent Discovery about economic challenges after reporting full-year results. That's next. This is Bloomberg. Shares of Africa's top insurer Discovery slumped the most in 3 years on Thursday after reporting a decline in new business. That is despite annual profit rising 30% after folding the global wellness program Vitality into a single business. The CEO, Adrian Gore, spoke to Bloomberg's Jennifer Zabazaja about the economic challenges.
It's a highly complex environment, I think, globally, geopolitically highly volatile, unknown. So that's a given. But, the reality is our model is about kind of use of technology, the demographic factors of people aging, chronicity, etc. So most of the trends that we are kind of tracking are accelerating. I mean, certainly the power of AI, not to overhype it, I mean, just the use of the data in a way that makes a difference. I think we have the most unique data set globally on this stuff, and therefore we're very well positioned. So no hubris, we have this kind of growth corridor we speak about, a 15 to 20% growth. We think we can achieve that. But there's a lot to be done. But the model is proving so applicable across so many different markets, different cultures, that I think we have a deep conviction about its applicability. So again, I think we're optimistic but realistic about it's not an easy environment.
Let's talk about South Africa in particular, because we did see South Africa actually posting the fastest GDP growth in a number of years. When we talk about the home market here, are you optimistic about the direction that it's trending in, especially when you look at it from the group's perspective?
I mean, it's a very, very complex market. The narrative about it is invariably worse than the reality. So, the market is bigger than I think people often think. There's a lot of really good stuff taking place. Business is working closely with government around a number of economic drivers, and I'm hoping that those things actually have got tremendous traction. For example, we turned the electricity crisis around. And I think, the sum of those reforms and a lot that were taking place, we are hopeful leads to economic growth. So we think the market has potential, but the market itself, in and of itself, as it is large for us. The bank's ability to scale significantly in the market is a reality. So there's a number of kind of tailwinds we're hoping for, but our group has done well typically in very complex markets, and the more complex they get, the better the model tends to perform. So again, nothing simple, but I think we're feeling quite confident about our ability to grow in the home market.
What are some of the tailwinds you are hoping for? Is it more electricity, more of the electricity crisis improving?
Well, I think that the economy's been flat for a number of years. Ironically, it's more resilient than people often realize, even with the tremendous load shedding and power crisis we had. The fact is the economy actually didn't shrink. But, business has a hope that we can get to 3% growth. That's going to be difficult to do in a short space of time. But if we get the economy to grow, and I think there's a strong feeling about the reforms and a lot taking place, that will be a tailwind. We haven't seen that for a number of years. So again, nothing simple. This is a complex environment, but there's a concerted effort amongst business collectively with government and all parties to get economic growth. It's about growth, jobs, and changing the narrative, frankly. We have to do that.
That was our Jennifer Zabazaja speaking to Discovery CEO Adrian Gore on the day of their earnings. All right, let's recap. Take a look at some of these equity markets as we head into Friday trade. It's been a positive week for Wall Street across the board. Once again, we have U.S. indices reaching a record high in trade yesterday. This after CPI data, which we'd been waiting for all week, came in line with expectations, around 0.3%, though perhaps a little few upside risks emerging. We're just speaking to Citi head of EM strategy, Luis Costa, who said the market is being a bit complacent about upside reflationary risks in the U.S. next year. So maybe something to think about. As of now, though, the market is cementing the case for the Fed to cut interest rates next week. About 2 basis points only priced in of a incremental and even bigger rate cut of 50 basis points. So unlikely that that is going to change in the coming days. This is the picture, not doing a whole lot. And that was it for Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.